Robschild. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Tuesday, October 22nd, 2024. Today's episode, I wanted to start with a brief discussion on AA bond yields being equal to PE ratios and how that works. I mentioned recently briefly about how you need to have a balance between what bonds can offer and what companies are earning. And one way to think about what a fair valuation of stocks should be, and this comes from Benjamin Graham's The Intelligent Investor, is this formula right here. All you have to do is divided by AA bond, the current AA bond yield. And that gives you a conservative, defensive PE ratio of a company that isn't necessarily, a defensive company, not a growthy company. One that's not expected to be like growing massively forever. Now, I've been talking about on the show all the time how the S&P 500 at a PE ratio of 30 is really high. And traditionally, it is very high. As mentioned in previous shows, multpl.com has a nice chart of a history of the PE ratio of the S&P 500 going back to 1870. And you can see over here that it's historically very, very high. Now, the thing is, so what does that mean? Does that mean that stocks should be a lot cheaper? Yes, sort of. But if bond yields are like really, really low, then a PE ratio of 30 can be considered to be a fair price. But the thing is, right now, bond yields aren't that low. Not right now, not yet. So then the question remains, well, where do bond yields need to be in order for a PE ratio of 30 to make sense from a defensive viewpoint? Now, in Graham's view from 1970, a fair defensive price was around 13, and funny enough, in 1970 it was basically at 13.85, and after, sometimes it gets extra cheap, like a PE ratio of 7, and sometimes it's a little expensive, around 20. But these were in an environment where bond yields were generally higher, and today bond yields are generally lower, but not low enough to make the PE ratio of 30 to make sense right now. And I'll show you why. From the St. Louis Fed website, you probably know about this site if you're doing anything with finance, we see the AA bond yield currently yesterday at 4.7%. Now, notably, this goes up and down. It peaked around, 5.8% recently. We dipped down to 4.3, so it definitely bounces all over the place. And when bonds were going to the moon, in what some people refer to as the bond bubble in 2020, the AA bonds dropped to a yield historic low, yielding only 1.34%. But the number we need to focus on today is 4.69. If we take 4.6 as the percent yield or on bond yield on AA bonds, you have 1 divided by that percent, you get the equivalent PE ratio of 21.7. So that's what Graham would consider to be currently, right now, a fair price of the S&P 500. Not crazily expensive and not cheap. Right now, it is 30, as you saw in the chart. So that's 33% higher than what would be considered to be a normal fair price, suggesting that, yes, stocks are expensive. Now, lately, bond yields have been climbing, and there's another piece to this. Forget for a second that I said bond yields are rising. That's the last piece of this. The piece before that is the spread between U.S. AA bonds and treasuries. Now, as you can see, typically this is below 1% for AA bonds, but it can get to 1%. It often it looks like it often gets to 1% every once in a while, but it generally stays somewhere between 0.5% and 1%. And right now, it's basically as low as it can get at 0.47. We don't typically get much lower than that. But what if we were to have credit spreads spread to a modest, 1% difference without even all yields rising? That would put AA bonds at a yield of 5.1%, meaning a fair valuation of the S&P 500 might currently be 19.6. Granted, this is only in the case if no yields change except for AA bonds spreading their credit a little bit between their yield and treasury yields. Notably, if yields go up, if all yields go up as they've been going up for like the past week at least anyway, they go up and down. But if yields were to continue higher, then, this number would actually drop, making the fair price of stocks lower and even lower than this, making the PE ratio of 30 seem even more ridiculous. Basically, the higher treasury yields go, the more ridiculous the overvaluation is of a PE ratio of 30. So then we're left with a question. Well, okay, so what would make a PE ratio of 30 a fair, conservative, defensive price for the S&P 500? And we can do that very easily. To get to 30.3, it's actually 3.3%. That's the number that we would need to see in AA bonds. So where is 3.3% on AA bonds historically? Well, right now, we're a good ways above it. But very, very interestingly, from about 2011 all the way till 2018, we were actually below this line, suggesting by Graham's own conservative viewpoint on valuation of stocks, he would say stocks were actually pretty cheap in general from 2010 all the way until 2018, and then before the COVID crash all the way up until about the beginning of 2022. Remember, this line represents a PE ratio of 30, meaning that all of this data below this line, stocks were highly undervalued and actually could afford a much higher PE, much higher PE ratio to be considered to be more normal. Perhaps the one thing holding back the market in this time was the expectation of yields to go back up. That's one option. Or just the fact that, PE ratios have never really been in the 30s for any significant amount of time before in history. Never. Now, granted, considering that I believe that yields will go back down, perhaps to this level or below, then, stock prices will make sense at that point. But we're not there yet. We're not there yet. As it stands today, October 22nd, 2024, stocks compared to bond yields are highly overvalued. And if yields, as many people are, there are lots of people that think bond yields will either stay where they are about now or continue higher, or have a higher low and then continue higher. And if that's the case, then stocks are clearly expensive right now. So any way that you put it, we're in a situation where bond yields are saying that a PE ratio of 30 is very expensive for stocks right now, period. If yields significantly drop or rise, I plan on keeping better track of this in the future regarding, the valuation of bonds versus stocks and what a fair price is. If bond yields were to drop, for example, very, very significantly, very quickly in the near future, then I can't say stocks are overvalued anymore. I still think we're at the part of the business cycle where we're likely to get that flush and earnings are to go down, and all of that. But that piece will be taken off the table if yields drop significantly, but we're not there as it stands. Next main topic of today is SMH, the semiconductor industry, clues in volume. I'm currently sitting on a speculative short position on semiconductors in the SOXS fund. The more charts I look at, the more excited I am about this playing out to my favor. In addition to this head and shoulders looking top, and in addition to this gigantic, large, formidable, engulfing candle of many trading days followed by a bearish looking flag, all evidence of this wanting to collapse, including this head and shoulders topping formation. Besides all of that, besides the fact that the PE ratios of semiconductors are pricing in massive explosion of growth of earnings moving into the future, and if we don't get that, then the current valuation makes 0 sense. The fact that there's a very high probability with all of those things in mind for this to drop as much as 50% from the high once we break this neckline. Besides all of that, I wanted to add volume into the picture today. Traders often talk about how institutions are operating and trying to get the most out of everybody. And when you see very, very high volume, these aren't little, these aren't little boys playing. These are big boys. These are the sharks. These are the whales that are playing the game when volume spikes. So when does volume spike recently in SMH? And when is volume light? These bars at the bottom of this graph represent volume. They represent the number of shares traded per day. This is a daily chart. Very notably, this giant red candle that I'm talking about in SMH happened not on light volume, but on massive volume, much higher than all of the previous days leading up to it. This, for a lot of investors, is a sign of institutions basically sitting on their hands, manipulating the market in order to let it float up, let it float up, let it float up. And when they see, potential, buyers maybe coming in, they flush and flush and flush and flush as much as they can at their target prices. Now, this was the first big flush to the downside, which adds to my case that I think we're going to go bearish here. But why is that? Well, let's go back a little bit. And I just want to point out a few other times where this was evident in this head and shoulders topping formation. So notably, the white whale situation that I remember Gareth Soloway on Verified Investing talking about, he talked about these two giant engulfing candles here, and this was the top, the absolute top of SMH. Leading up to it, you can see these volume bars pretty low, and when we get to that flush candle, massive, the largest amount of volume right there, and then dying off, and then the volume drying up, and it's floating up again, and then again, spike in volume, selling to the downside, and then going sideways, spike in volume, going down to the downside, and we have just volume increasing here, and once we get to a bottom, it cools off, and the volume's kind of, it's going down. And then once we start flushing again, the volume starts picking up again. And then the bigger flush, the bigger the volume. Scrolling backwards to the left shoulder of this, the first engulfing red candle of the left shoulder, same exact thing. All of these little candles, low volume going into it, and then the big red engulfing candle signaling a reversal to the downside, happening with massive volume. And again, what do we have very recently? On October 15th, massive flush to the downside, massive volume. This is setting up a very bearish move. I'm very happy to be short this market with where we are in the business cycle, with The Fed's saying they're basically fearing what's going on in the labor market with crazily overvaluation and thinking that this entire industry will make an infinite amount of money into the future. I'm happy to be a bear here. Last main subject today, Thursday, watch out for PMI, and initial jobless claims, both or either of which has the potential to send markets flying. You know, these kinds of reports can be muted and not really have any effect, but it has the potential to rock things. If you want to hear about the daily reminders, watch Monday's show. Nothing's changed in any of this as of today, and crystal ball reading remains bear market very soon. Fed won't cut fast enough to save the economy. I don't think I've ever opened a chart on my show before that shows minute by minute bars, but I did find it to be very notable that there's a similar thing going on in the S&P 500 as far as volume increasing while markets are selling off. This tells me institutions, big fish, big whales are dumping here. Look at this volume spike at the end of the day and this absolute crash at the end of the day. Final 5 minutes of trading. The whole day having almost no movement, relatively speaking, and then that gigantic spike at the end of the day tells me that, I mean, it adds to the bearish case here. I don't know. I think stocks are overvalued. It makes sense for them to go down right now. What else can I say? Now, if all you're looking at in the S&P 500 is a daily bar chart, you don't see that end of the day drop. In fact, it's a green candle, and it looks like it's going sideways. So friendly here. Yeah, you know, the buy the dippers are coming in and the institutions are flushing, I think anyway. I'm not alone on that. But Mr. Market still got his, you know, well, he took his foot off the gas. We're going sideways here. We're not speeding up anymore. The VIX future curve caught my eye today only because it seems like the January, February, March contracts have actually dropped. You know, the VIX itself didn't really move much today. We went sideways. This is the VIX chart here. Today didn't move at all, but the VIX futures all of a sudden were more elevated. Yesterday and the day before, we were not elevated above the next like 3 or 4 months. I don't think anyway. And so I think the markets are kind of getting a little excited about the idea that post-election, typically you get a rally in markets. Like going into elections, apparently seasonality-wise, there's more expected volatility. But then you also get the Santa Claus rally, so December, end of the year kind of rally. So that's why you have this dip here. But the months following it being lower than the current futures contract, saying that the market's sort of expecting a rally here, January, February possibly, which makes total sense. Now, will that play out or not? Yeah, hard to say. I mean, it almost allows institutions to dump more shares if there's less fear priced in. You know, these same institutions are the ones that are selling these options contracts, and you know, with there being less fear priced in, maybe it's like there's less volume happening in the options markets in general. I'm not really sure. Copper caught my eye today only because it's pretty clear. I mean, if you studied charts at all, this is a pretty darn clear bull flag. So, you know, maybe this is a sign China's about to have another leg up higher and, you know, show some kind of strength along with copper. I don't know. But this chart by itself says copper wants to go higher. I noted over the past several days while this was hitting all-time highs in XHB, the Home Builders Index, how I thought this was getting overly optimistic, and we cooled off significantly over the past 2 days. Today we went down another 2.6%. There's some home builder report, something to do with selling new homes coming out tomorrow. I'll only include it in the show if it's interesting. But maybe we're preparing for that report to be weak. I've been bringing up the dollar a lot recently, how we've been on a tear to the upside, had that one yellow day. Sorry, that one red day down, followed by a surprise green day, getting us straight back into this pattern. And yeah, it continued today. Dollar to the moon, apparently. You know, this is all while we're not seeing Bitcoin collapse. We're not seeing gold collapse. We're not seeing the S&P 500 collapse. Something's amiss here. I suspect the S&P 500 is going to get a wake-up call very soon. Another chart that really caught my eye today was actually the U.S. Treasury yield curve, only because we have recently been getting flatter and flatter. Now, with the recent rise in the 10-year Treasury, and while, you know, the front end is dropping and the Fed funds rate and all through the 3-month and the 4-month, well, you know, the 3-month Treasury right now is yielding 4.7%, while the 10-year is 4.2%. That's only a 0.5% difference. That's 50 basis points of a difference. We're close to uninversion, guys. It's going to happen likely within the next 2 months, actually. Typically, when the front end drops below the long end, especially specifically the 3-month drops below the 10-year. When that happens, that's typically like, okay, we are now in a recession scenario. So pretty exciting, to say the least. Speaking of Bitcoin, as I mentioned yesterday, Sunday's confirming candle saying, yep, we're going to go up to 100,000 now, or at least 75,000. Nope, said the market on Monday. The main, you know, I don't have a lot to rely on as far as like where Bitcoin price is going to go. I can see on the chart pretty clearly if it's like up or down. If it's gone down by 50%, then yeah, it's probably cheap. But it's near all-time highs, and the other way I'm doing this is just going off of what Gareth Soloway says on his show, Verified Investing. He sounds scared of Bitcoin right now. So my crystal ball says don't touch Bitcoin for the moment. You know, on top of that, it's a stupid time to get bullish with the valuation of everything going on, especially that divergence I spent 10 minutes at the beginning of the show talking about between treasury yields and the S&P 500 valuation. And don't forget, by the way, too, the leading economic indicators index just dropping like a stone, and for like the first time in history with no recession. Like, yeah, maybe it's different this time. Yeah, maybe. I digress. Sorry, I'm getting so excited. Markets are finally getting interesting. You know, summer is so boring. September, October, we got an election. Woof. Fun times. Again, I'll bring up the 10-year Treasury note yield from the top of March 2021, hitting the neckline of this Head and Shoulders top here that broke. Looks like we're headed to retest it. This explains, I believe, Gareth Soloway also, he references 4.38. He doesn't talk about this chart. Maybe his paid service. I don't have his paid services. He must talk about it with the guys that he pay, the guys that pay him to do what I do for free for all of you. By the way, donate to the channel. Information below. So yeah, I've been saying it looks like we're climbing back to this purple line here to retest it. It's playing out pretty much like clockwork. We are rising here. It looks like we're gonna get there. At that point, I will be buying TMF at that point. It's a leveraged form of long duration treasury bonds. I'm already over 50% in long duration treasury bonds, but I'm gonna buy more. Last chart of the day, it will be silver. It looks like we started a new candle. This is tomorrow. It's because I have UTC time, so this is actually tomorrow time. Today, the October 22nd, we closed a leg much higher, 3.19%. Personally, I think that silver is a good price, around a fair-ish price, around $20 an ounce. Currently at $34 an ounce. Like, okay, yeah, and it can go higher. You know, look at the history of silver and the short squeezes on silver. It's like amazing. It's like it happens it's happened so many times. It seems like people never learn that. Yeah, sometimes it goes to the darn moon and then it comes straight back down again, because silver's not, it's not that rare. It's not that hard to find. I mean, for goodness sake, we have, just so you know, we spray silver into the air. We use silver to make these chemicals that supposedly help with the rain, and they might even be involved with fertilizer or something like that. I thought I remember. But you know, it's a precious metal, and it's an industrial metal, and there's plenty of it out there. You know, and then you have these situations every once in a while. Everybody hoards their silver, and no one wants to sell it, and it goes up, and people think it'll keep going up, and so stupid people buy more of it, sending the price higher, and until, you know, the balloon pops and everybody realizes that there's nobody left to keep the price of silver going any higher than that, and then we get back to like a normal, you know, range of silver, you know, compared to other things like food, houses, wood, gold, whatever. Personally, I find it very entertaining, and I have zero FOMO. It could go up to $1,000 an ounce, and I'll still sit on my hands and say, oh, I don't care. Maybe I'll short it at the top if I can figure out where the top might be. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.